Welcome back, everyone. Jeff Dagner here with Ausperity Private Wealth, joined with my partner, Rory O'Hara, and this month we're going to be talking about a timely topic, searching for yield in a time of uncertainty, and the theoretical concept of risk-free assets.
Yep, and this kind of is spurred by recent discussions we've been having with clients that we're asking that they reevaluate the return that they're getting on cash, bringing awareness to how much cash they currently hold and where they hold it with some of the concerns over certain regional banks. So we figured this would be a great webinar topic, so here we are.
Absolutely, well put. So some key takeaways, as I had referenced earlier: risk-free return, a theoretical concept. It's a represents the expected return on an investment that carries no risk. Again, with risk comes reward, as we know, and we'll kind of dig further into some of the different risks associated. But overall, the focus is that the concept of cash seems like there is little to no risk, and overall there is a term associated with that, which is a risk-free asset.
Yep, and the term risk-free return doesn't really exist, and we're going to explore that because there are different forms of risk, which I think brings us to our next slide. So first is liquidity risk. So that is essentially having an investment, and then when are you able to access that investment? So that risk theoretically would be a liquidity risk. Many times that's going to be seen when working with private investments. You purchase an investment, and then you're mandated to hold that investment for maybe 1 year in the case of certain evergreen private funds, or in a capital call structure, you may not have any access to liquidity. So what's the reward for taking on the reduction of access to your investment? That would be known as liquidity risk. Purchasing a bond that you choose to hold to maturity is going to be some liquidity risk, and not having the ability to access those investments. So there's just a few examples of liquidity risk.
Yeah, many people full and well understand market risk, and that's when a stock can go up or down, or this value of a stock goes up or down. Typically, when you're taking other types of risks, there are benefits provided on the back end. Inflation risk, and Rory, why don't you talk a little bit about this? I mean, it's something a lot of people know full and well in this environment.
Well, yeah, exactly. We've seen a massive increase in inflation over the last 12 to 18 months. That's felt by all of us as consumers in the U.S. economy. Inflation, meaning the cost of goods and services, has increased. You're seeing this evidenced by at the pump, and the price of gas has gone up. The price of food has gone up as well. So inflation risk, as it relates to your investments, is, are you producing a rate of return that will actually net growth for you when you factor in the cost of goods, services, and just normal lifestyle? So what we've seen is inflation has increased, so a higher rate of return might be needed to provide an after inflation type of return felt to you as a consumer. So with that inflation increasing, our government knows that we can't have a sustainable inflation of 6 to 8%. So we've been increasing interest rates to try to bring inflation down. It's taken some time, but we have started seeing some signs that inflation is starting to ease. But the risk as it relates to your investments is, yes, you might be able to get a rate of return, and we're going to talk more about how, because the Fed has increased interest rates, cash is yielding more. But if you're getting a yield of 2 to 3% in cash, but inflation is running at 5 or 6, over time, your wealth is going to be eroded because the cost of what you're purchasing is superior to the growth of the investments. So that's how you should really think about the inflation risk associated with your investments.
Perfect. And it's typically why when we're measuring a targeted return for clients, it's typically based on where inflation is, or the cost of living.
Exactly.
Interest rate risk. So for, I guess, back in the 80s, and many know full and well, interest rates were double digits, and CDs were being issued at double-digit returns. For the past 30 years up until recently, interest rates were falling, And as interest rates were falling, so were bond values. Now that we're in an interest rate rising environment, bonds also take on that interest rate risk, or they're interest rate sensitive. So uh, if you were owning bonds or CDs that were issued when rates were 1, 2, 2.5%, and rates are now 3, 4, 5%, that bond is going to drop in value, which is why last year we saw bonds, fluctuate almost to the tune of what stocks were fluctuating. However, now bonds are being issued at a higher interest, and they could even be purchased at a discount. So in those circumstances, if you're buying a bond that was purchased at a discount and it's yielding 5%, the yield to maturity might be closer to 6.5%. Something to consider there. Rory,
Yeah.
you have anything to add?
I think interest rate risk has been the most felt by consumers and investors. So interest rates have gone up. So there's some positives there. The yield that you're getting on cash or safe investments like treasury bonds, CDs that we'll get into next has gone up significantly. So you're going to generate more income and a higher rate of return from those investments. Some of the negatives of rising interest rates is going to be lending, what you might see in credit cards, but especially the focal point now has been on mortgages. You buy a house today, your mortgage rate is likely double than what it was 18 months ago. So the mortgages are more expensive for the consumer. And I think the middle bullet point that Geoff, you mentioned in your kind of overview says it perfectly. When interest rates rise, the price of bonds decreases. Why? Well, it's because new issued bonds are yielding more. They're going to be more attractive. They're going to garner more demand. So if the demand decreases for an existing bond that was purchased a year or two ago, only yielding, say, 2, if new bonds of that same issuer are yielding 4, the demand for new bonds increase, the demand for those existing bonds decrease. Simply supply and demand, back to old economics. In contrast, when interest rates decrease, bonds increase, right? That's what we experienced leading up till last year. We now got to feel the effects of a rising interest rate environment and how that is affecting existing bonds. Really good for new issued bonds or new issued CDs or certain assets. But if you're holding existing bonds, you felt that pain. Good news is, as we talked about our Bond 101 video that you can also see on our YouTube channel, is if you're patient, you will see that bond price recover as those bonds get closer towards maturity. But what we are in now is a vastly different environment for some of those safer investments that are now able to generate a decent return. So we're going to dive into more of that. But this is a great opportunity to reevaluate cash, reevaluate your bond assets and your bond portfolio, because we have been through a massive, really a historical increase in rates in a very short period of time. Hence the need, I think, for this discussion.
Absolutely. And that kind of leads perfectly into the discussion on the yield curve.
Yeah. What do we
see? The yield curve, I mean, as simply put, it's a line that plots interest rates of bonds having equal credit quality but differing maturity dates. So, think of it as a 1-month treasury versus a 3-month, 6-month, even the 12-month, 18-month. And are you being rewarded for taking that liquidity risk?
Yep. So we'll go through what are some of the curves, right? Or what do they look like? A normal, to your point, Geoff, is common sense would dictate if you're going to tie up my money, I'm going to take on liquidity risk by purchasing a bond that's several years out. The expectation is that I'm going to be rewarded with a higher interest rate. That's normal. That's fairly common sense. You have a flat yield curve, which is, pretty rare, but it's where you're not compensated for taking on additional maturity or additional duration risk. That's not common, but that's also not the environment that we're in. Rather, we're in an inverted yield curve environment where it's short-term bonds, because that's what the Fed controls, is raising short-term rates. We're pumped up significantly. The later part of that curve has not caught up. So we're in a really unique environment where shorter term bonds are yielding more. Geoff, maybe you can talk about how that's abnormal, because typically you would be in that normal yield curve. The longer term bond yields the most. That's just not where we're at. And I know we've dug up some stats to show present day. What are some of those yields?
Yeah, just to touch And again, the inversion of the yield curve is a scenario that the yield curve, it's views the consumer sentiment, and the economy, and where we think consumer sentiment lays. It says it pretty clearly here. With a normal yield curve, it's typical of periods of economic expansion. The inversion of the yield curve is one where, yes, there is uncertainty. There are many circumstances where an inverted yield curve led to a recessionary environment, but the yield curve flattening over time, or an inverted yield curve flattening over time, is a good indication that we're looking to turn the tides. This just shows the 1 month treasury versus the 6 month. Not too much of a difference, but you're not being rewarded for taking that
Exactly.
liquidity risk.
Yeah.
Why would you buy a 6 month versus a 1 month? Well, maybe you want to lock in that interest for 6 months, and you think that the Fed is potentially going to reduce rates within the short term. This is a much more dramatic shift, looking at a 1 year versus a 3 year. And if I look at the 3 year versus the 1 month, that's the difference of almost 2%.
Mhm.
1%, just taking two additional years of liquidity risk, I'm getting a 1% reduction in income. Now, there are situations that might warrant buying a 3 year bond, maybe not a treasury, but maybe a corporate that's trading at a discount but yielding 3.5%, and that's because it's trading at a discount. So the yield to maturity might be more attractive. But in this scenario, we're looking at newly issued treasuries. So again, over time, you can see how the line plots. It's an inversion of the yield curve.
Yeah, it's very clearly seen that we're in an inverted yield curve environment. You're not getting paid to wait. So you can clip some really nice returns with relatively low risk, utilizing some of what we have on the screen here, and pick up that 3.5, sometimes maybe even 4% return due to the inverted yield curve, which is a signal that things are different right now. And yes, we have to expect it's a different environment. Inflation and interest rates are in a completely different place than they were a year ago, 18 months ago, and then even for the last 30 years. So it's not shocking to see that we're in this inverted yield curve environment. What we need to do is evaluate, what do we own, why do we own it, and are there some opportunities? And what are alternatives to just keeping the money in the bank? We're going to go through a few of those, but we've laid them out here as probably the six that most investors would know. So I know we can kind of kick to the next
this
one.
is like I look at this as a tiered approach. I mean, we all are very familiar with the concept of a diversified portfolio. Well, this is the concept of diversifying your cash reserves. Understanding that liquidity risk isn't a bad thing, and where can I maybe pick up a little bit of increased yield and diversify myself against any major unforeseen situations.
Yep. So you can go to treasuries, backed by the government. So that's going to be your highest quality, least risk of default. And there's three forms. There's treasury bills, which are going to be a few days out to a year out, would be treasury bills. We've done some 3-month and 6-month laddering for select clients, primarily that have an actual need for funds outside of 3 to 6 months, that want to take advantage of this inverted yield curve and theoretically, guarantee a return over those next couple of months, so long as the government doesn't default, which is an extremely rare scenario. Then we can go a little bit longer out there and look at treasury notes. That would be 2 to 10 years. This is something we're typically not buying individually for clients, just like treasury bonds that could be issued much longer out, 20 to 30 years. Instead, what we're doing is relying on the portfolio managers and the bond managers that we use for clients to make the decisions of treasuries versus corporate bonds versus bank loans versus tax-free municipal bonds. And right now is an actually great environment for a bond allocator, meaning a analyst that can look across the landscape and look for discounted bonds, to Geoff's point, to look at bonds that are going to provide a yield that's fairly decent in a short period of time. So forward looking, we really believe this to be a great opportunity in the bond market. At least at Ausperity, our belief was that the bond market bottomed in the fourth quarter of last year and is beginning a recovery. So what's getting a lot of headlines is quote unquote risk-free investments like cash and money markets that could be yielding upwards of 4%. Well, what's flying, in our opinion, under the radar is that you have the Lehman aggregate, which is essentially the main index that tracks the bond market. That's up nearly 4% so far this year. Well, that annualized is on pace for a near 10% rate of return. So we're seeing that come back, but a lot of the focus is on what you can kind of access quickly or what investors appear to be risk-free, and that's typically just associated with cash type investments. So if you want to go really high quality, but give up a little bit of liquidity and kind of lock in a yield or lock in a return, you can look to the Treasury market and buy a bond from the government. And these are three various forms.
Yeah, well put. Well put. Oh.
Yeah,
So
Geoff, take us through some other options that are out there in addition to the Treasury bills that I alluded to for fairly short term.
Yeah, so we touched on the Treasury. The Treasury holds auctions, and it's really what allows them to raise capital. The money market we've touched on. We haven't really focused in a finite matter. There are several different types of money markets, which we'll get into on slides to come. CDs, I mean, certificate of deposit. It's typically issued by a bank. There's bank issued CDs, and then there's brokered CDs. CDs are typically you're taking liquidity risk.
Mm-hmm.
Anywhere from 6 months to 10 years. And the yield curve with CDs is similar to that of treasuries. I mean, treasuries tend to be the benchmark by which CDs and other other structures like that are issuing their debt. So typically when you buy a longer term CD, you would hope to be paid a higher interest, and that's just not the case in this environment. And then we've got zero coupon bonds, which many may not realize that they know what a zero coupon bond is, because back in the day it was pretty popular to buy a savings bond for the birth of a new child. You buy a zero coupon bond or a savings bond at a local bank, or I believe Treasury Direct is where zero coupon bonds can be purchased today. Think of it this way: you buy it for $50, it matures at $100 at a set period of time. No interest payments. You're basically buying it at a discount, and at a set maturity date, you will have double your investment. Now, I've run into a lot of clients, or typically it's a client's parent passes away, and as they're organizing their estate, they find savings bonds that matured 10, 15 years ago. Well, when they mature, there's no more future growth. So that's even worse than having money in the bank in cash that's maybe yielding a 0.25%. It's you're giving up all future growth if you do not cash in that savings bond or that zero coupon bond when it matures. So again, it's important to know what you own, know what you have in your portfolio or under the hood of your financial plan. Anything to add there?
No, just CDs. You mentioned liquidity risk, but there's also interest rate risk there as well. So if you buy a 1-year CD, you're buying it at current rates. So if interest rates decrease between now and when that CD matures, likely that's going to be beneficial for you, at least in terms of opportunity basis, where you bought a CD at a higher interest rate, it matures, and if you redeploy it, you're redeploying it at a lower interest rate. It could work against you, and that's what investors have seen, that if we're in a rising interest rate environment, you purchase a CD today, interest rates rise. If you hung on a little bit, you could have bought a CD that's going to yield and generate a higher return. So the liquidity risk is selling that CD. You're giving up some of that return, via a penalty by exiting. But when you purchase a CD, when you purchase a bond, you're taking on some interest rate risk because those rates are going to be moving. They could move in your favor or they could move against your favor. So something to note that with CDs, bonds, etc., you got liquidity risk. You're also taking on some interest rate risk as well.
One thing additional on the CD front, I've heard from many that, they don't want to sell a CD because of the penalty. I mean, in reality, they call it a penalty. Really, you're giving up the interest from when interest last paid. So if you own a 5-year CD that pays interest quarterly or semi-annually,
Right.
you're and you liquidate if it pays semi-annually and you liquidate after 5 months, in May, then you're giving up that first 5 months of the year worth of interest. But at the midway point through the year, you've got full ability to liquidate and the penalty is zero, or the interest that you're giving back is zero. So again, know the structure. And
No, I'm glad you
again,
brought that up too, because that's a prime example. That's been done. Investors purchased 5-year CDs several years ago. And that 5-year CD, even though you're giving up liquidity for 5 years, that's got a lot more interest rate risk than buying a 1-year CD. And that 5-year CD, maybe let's say was paying you 3%. Well, it's got to be painful to see that you're stuck holding this CD for maybe another 2 or 3 years. Yeah, you could buy a 1-year CD today and get basically 5. So that's an example right then and there of interest rate risk, and why, to Geoff, to your point, you should evaluate that CD. If I exit early, what is the penalty or what am I giving up? Because maybe I can redeploy it and generate a higher yield. What's the break even on that decision? That's something we can certainly help with. But that's what's taken place. A lot of investors that loaded up with longer term bonds and then saw interest rates increase are sitting there saying, man, I don't want this bond. I'd rather it mature so I can take it, redeploy it, and purchase a newer bond at a higher interest rate. So it's the environment that we're currently in, hence the need to take a look at what you own and what options are available, which leads us right into this. There's an expectation or there's an assumption that savings accounts are still paying basically zero. And that's just flat out not true. The national average for savings accounts is 0.25%, according to the Bankrate May 10 weekly survey. So that's an average account of interest rates. And that's because, unfortunately, a lot of these big banks have savings accounts still yielding, surprisingly, 0.2%. There's other options out there that we're going to explore. 1-year CDs paying, in the high 4% range. But I think that this is a really, really big point that we want to drive home. It's kind of why are we having this discussion? Do you know what your cash is yielding? Because the big banks are not knocking on your door saying, hey, there's some other options here. There's a high interest money market, or maybe there's a money market fund you're interested in that you can 10x your yield. Is that something you're open to? But it's not happening. So a lot of investors are sitting in savings accounts yielding zero, and general checking accounts yielding zero, maybe 0.25. That's the national average. If you look a little bit harder out there, you can be looking at 4, sometimes maybe even 5% returns on cash-like investments.
Yeah, if you see down below, the high yield money market tends to pay, several times the national rate. Typically, that they're found at online banks and credit unions. But the overall theme of this discussion is if you could take anything away from today, it's know what your cash is yielding, and maybe get a sense of what your liquidity needs are with that cash, because I know the uncertainty of the market tends to have people stockpile their cash to a degree on the side. But if you're not pacing with inflation, like Rory mentioned earlier, you're typically losing value.
Right. Yeah, so let's talk about what we're offering, or at least the conversations we're having with clients. to what that other slide pointed to, we're going to be diversified. There's an environment to hold stocks, to hold bonds that we talked about, but also to hold fairly safe investments, whether that's for a potential emergency and you need an emergency fund as a homeowner, as a parent, or just as a consumer in today's economy, or maybe you're holding additional funds because there's a large upcoming payment, whether that's tax oriented or a large purchase or a second home or whatever that might be. That type of investment you probably want to have safe, but you probably want it yielding more than 0.25%. So there's money market savings accounts, which, Geoff, maybe you can kind of talk us through here. And then there's money market funds as well.
Yeah.
And then lastly, there's the jumbo or a preferred money market. So here are 3 different instruments that you can look at, all of which you'll see are averaging yield significantly above that 0.25%. But you might use a combination of these or might gravitate towards ones, not without quote unquote risk that, Geoff, I think you can talk us through.
Yeah, the money market savings account typically is at a bank or a credit union or even an online institution. But these are situations where your money is FDIC insured up to 250,000. I mean, with some of the financial, the banking issues that we've seen lately, I mean, it really makes you have to question whether that $250,000 FDIC insurance even matters.
Right.
When the federal government said that we're gonna make sure everyone's made whole above and beyond that 250. So again, I with anything, as you take risk, there typically is benefits or higher returns on the other side. The money market savings account is going to be the lowest risk possible. With the money market fund, there are instruments that underlie that vehicle. Now, it is fully liquid, meaning within our client accounts, it typically is cash sweep functionality, means as cash is deposited into an account, it is invested directly in that money market fund. Mm-hmm. If cash is transferred out, it is pulled directly from that fund. There is no action that we need to take to purchase. It is simply swept in and swept out as transfers.
Minimal liquidity risk.
Yep. They use very low risk investments, treasuries, even CDs, even some of the investments that underlie the money market funds could potentially be FDIC insured.
And what we're seeing is yields upwards of 4 3/4, which is it's a nice number. You have $20,000 sitting in a money market fund. You're looking at a pretty decent return in terms of that return on cash compared to 0.25, 10,000, et cetera. So your money's working for you in that instance. The question is, how important is FDIC insurance to you? Because that's kind of the main difference between a money market fund and the money market savings account.
Yeah. And I think that the second bullet point in the money market fund is actually really important because the SEC introduced regulation which was implemented that really helped protect money market funds, because technically there could be a fluctuation for a short period of time within that money market fund, but these have become very secure, regulated structures, fully liquid. They're actually very, very widely used across not only brokerage firms, but retirement accounts, insurance companies. They manage their general account, and that's sort of like a money market fund.
I mean, it's our default cash investment is a money market fund at Fidelity. That's our default cash option, sweep in, sweep out. And we did do an evaluation and change the money market fund we were using last October. That one, as I said, give or take a day or two, is upwards in the 4 3/4 range. So it's a nice return on cash, something that's being provided throughout the course of the year.
And the only difference between the money market fund and the jumbo or preferred money market fund is typically the jumbo or preferred is going to have a minimum level of entry.
Yep.
And in many cases, that is an initial entry point. So 100,000 minimum to get in. It could be drawn down to $1, and you can always get back in. That's not the case with every institution, but from my experience, it tends to be the case, for most. But understand the process there. If you fall below whatever their minimum is at whatever institution, maybe they drop you back to that money market fund rate. Again, know what the process is. I mean, the difference between the two from our experience is about 20 basis points, but
Hmm.
that's 20 basis points. So
That's
it's
national average
yeah,
on
yeah.
on savings accounts.
There
Yep.
you go.
Yep.
Well put. Yeah, and this kind of focuses a little bit more on the differences between the two. So FDIC insurance versus um, safe but not insured against loss. Money market account has a stated interest rate, which varies among banks and credit unions. But again, as interest rates fluctuate, they have the ability to adjust that stated interest rate. Um, I think I think we've covered the differences between the both, and
I think
this
the big one
slide
is
is
FDIC insurance,
yeah.
right? Money market account FDIC, money market fund no FDIC. Money market fund is going to be marked to $1. Is there a scenario where it could price itself below $1 temporarily? Sure, right? But has that happened in the last several years? No. Is that likely? Not very likely. Something to think about. Great financial crisis, certain money market funds did price below $1 temporarily, and then reverted back to that $1 mark. So those are the main differences that you have there. Still liquid, still very safe investments, but there is a difference. Realize that difference, and the question probably is going to be, is that something you're comfortable with? Because you're going to be rewarded. The money market fund could potentially give you a 2x yield above a money market account. So maybe you diversify and you have money in both. And that's something worth looking at. What you shouldn't have is a bunch of money in a checking account earning zero. That's
Yeah,
the big takeaway.
yeah, absolutely, well put. I mean, that third line item kind of tells the story a little bit, and it's not it this isn't sort of the definitive truth, but the way I look at it as the money market account is typically held within a bank, and again, this isn't the stated process. It could be held in an online account, but the money market fund is typically associated with like a brokerage account where other investments might be held. So
Mhm.
that's the way I kind of view it to a degree. Okay, the I series bond. This is another vehicle, low risk, potential for return. Rory, you kind of hit on this with our clients in the
Yeah.
past and past newsletters. Why don't you take this one?
Yeah, we just thought this would be a good update because we pounded the table on this idea at the end of 2021 when inflation started to increase. So I-series bonds really earn their return via a fixed rate, which is based on current interest rates, and then also an inflation rate. So, in fact, this is an investment that benefits from higher inflation. So, with inflation increasing, I bonds were uniquely yielding somewhere north of 8%. And this was a year ago at a time when your CDs, 1-year CDs, your money market funds were 1% or below. So it was a kind of rare random occurrence to purchase an iSavings bond. So I know we did a video about it. We wrote an article about this and then published it in our newsletter. And a number of clients took us up on this unique opportunity. Sorry, I misspoke. Not took us up on it. You have to buy it directly through the U.S. government and the website we provided below there. So great opportunity. But now that inflation has started to decrease, we got to evaluate this once again. And on the right-hand side, you're seeing that for I-bonds issued May 1st of this year through October 31st, that 8% has been dropped down to 4.3. Still a pretty good yield. But I think we should really be looking at the October timeframe and circle that date as an opportunity to possibly exit the I-bond because we might be able to then purchase another bond of similar or larger yield with potentially more liquidity. So something to think about there because inflation's dipping, the opportunity is potentially drying up. I wouldn't rush to take an action now, but start looking at this in early October before the next interest rate resets. And maybe this is a time to sell that I bond and then reallocate funds into other investments that could be more liquid or could be yielding more. So just an update on I bonds put it on your watch list. It's no longer the no-brainer opportunity here to grab a quick 8% when everything safe was yielding 1. Now safe risk-free investments are yielding north of 4, depending upon what you're looking for, and the I-bond yielding 4. So they're kind of equals right now. I don't think that's going to be the case forever, especially if inflation drops. We might see this I-bond drop below what a normal money market fund might provide. So put that on the watch list.
And I would add that it's not a one size fits all. So one of the caveats, if you remember when we sent out the commentary and Rory talked about this, there were some aspects in order to lock in a specified return. I believe if it was sold within or after 6 months, but before the first year, you're going to get back a quarter's worth of returns. If it's held for a year and a day, then there's a locked in value. So I think when you purchase it, there's a factor involved there, and consult with us if you have any questions.
Yeah, generally speaking, ideally you sell the I-bond after holding it for a year and a day. That's where you're going to get the majority of that yield. You're going to forgo a good portion of yield if you're selling the I-bond inside of 1 year.
Yep, well put. And yeah, that I-bond, when that opportunity was presented, when things were kind of looking pretty poor, people were like, let's shoot the moon on this thing. I will remind everyone, it was a $10,000 minimum or maximum purchase per individual or per social security number. So
Right.
yeah, but it's again, know what you own. Sometimes these things like savings bonds go by the wayside. People forget about them, and might your heirs might be uncovering the fact that you purchased an I-bond way back when. So yeah. All right. Well, we covered a lot. I mean, one of the final thoughts I would hit on here. We focused on cash and short-term investments yielding. Rory hit on the fact that interest rates have gone up and mortgage rates are higher. Auto loans are higher, but it's all relative. I mean, so we're also in an environment where cash or money markets are yielding 5%. So when interest rates were next to nothing, yeah, mortgages were very low, or in the 2.5 to 3% range. But take advantage of the environment, not to the degree where you're going to put money in cash or some low risk or risk-free investment for the rest of your life. I mean, somebody very wise that we were listening to recently said it best. It was, cash is a great place to allocate right now, especially if you're sitting on excess cash in the bank and it's yielding next to nothing. But you date cash, you don't marry it. And Rory brought up some really good opportunities within the fixed income space that we believe is again a good balancer to that cash allocation.
Yep. I think my final thoughts is the ask I would have is dig up your checking account and your savings account and look at what interest you're generating on that account, because there are other options. So then reach out to us and we can explore some of those options with you. You can maybe make a like-to-like move if you're concerned about risk or seeing the money drop in value. You're going to want to probably take a look at a money market account or a money market fund. Maybe you can take on a little bit of liquidity and interest rate risk, and you can look for a CD or a treasury bill. But there's other investments out there. I mentioned the opportunity of what we're seeing in bonds. Bonds are recovering from last year's difficult markets. There's some private investments that we've been looking for. There's a private lending fund yielding over 10%. So it's just a different environment that we're in now than we were 12 months ago. So I think you want to reevaluate the safe side of your assets, make sure that you have your money working for you, because most investors are under the assumption that cash is still just paying you zero, and that's not the case. So my final thought would be to dig up where you're holding your emergency fund, where you're sitting on maybe larger than normal cash, and reevaluate where you want that money held, how it's being deployed. And we're happy to talk through that further. So thanks for listening. Hopefully this was a very worthwhile webinar. It's one that we kind of threw into the mix just based on the conversations that we're having with clients as we're trying to educate them on evaluating their cash positions. And we've had a lot of success with clients uncovering, hey, I got significant money sitting in this bank account with this bank or that bank, and I just never thought to look. And yes, it was paying 0.25%. We can make a lateral move and maybe get that at 4.5, 5, or a premium money market at 5%. So, take a look at it, put some time in, know what you own and why you own it.
Thanks, Rory. All right. Until next time, take care.
Thanks, guys.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.